It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome, everybody, to the Your Personal Bank Show. It's Ferenc. We're going to cover a lot of great stuff, and I'll tell you what, we've been covering in the last few weeks a couple of the key issues that I see people run into in terms of challenges when it comes to your money. Things that impact you negatively. That, of course, is debt. We talked about debt a couple of weeks ago. We talked about how the difference of, strategic debt versus consumer debt. And so understand, I know there's people out there that teach that, debt is bad, get out of debt, pay off your debt. And in general, that's a good idea. But here's the thing. You really need to understand the difference of strategic debt versus consumer debt. If you don't, I'm going to highly recommend you go to moneyradio1510.com and go to a podcast and look up Your Personal Bank Show and listen to our previous show regarding consumer debt versus strategic debt. It's very, very powerful. The key is real simple. Strategic debt, you can build wealth with that. That's where you're controlling debt. A great example is rental property, for example, where somebody else is paying the mortgage. Consumer debt's known as bad debt. If you have to make the payments from your efforts, that's bad debt or consumer debt, okay? You do want to get rid of that as soon as possible because that's what can get you in trouble. And then the other thing we talked about previous show was tax-favored income. Taxes are a big issue, and most people are not as familiar or pay much attention to the impact taxes have on their investments as they should. And what I mean by that, particularly if we're going to talk about qualified accounts, your IRA, 401ks, 403bs, all those fun things. Bottom line is taxes make a huge impact on those. And the thing you need to understand is you've got to ask yourself the question, everything being equal, is it better to pay taxes on the seed or the harvest? And again, I recommend going back to the previous show and listen to that further if you really want to look into it. But do you want to pay taxes on a small amount of money now or a much larger pile of money, hopefully, in the future? Certainly at a historically low rate right now, you're deferring at a historical tax rate now into an unknown rate in the future. Is that a risk worth taking? That's something you should analyze and look at, of course. So we've talked about debt. We've talked about taxes. We've talked about how these things can really impact you in terms of negatively affecting your money or how much you have to spend, if you will. Now we're going to talk about the third concept that's so powerful and important to making a difference, changing your financial future dramatically. And it's my favorite one I like to talk about, and it's compound interest. And understand, tapping into the power of compound interest. Really, that's the key thing you need to understand in terms of long-term growth going forward. We talked about that again at a previous show, and I'm going to recommend going back and listening to that if you want to learn more about it. But the power of compound interest is really simple. I always refer back to what we call the Rule of 72. Now, I'm surprised, I'm amazed when I ask people, how often are you familiar with the Rule of 72? And the Rule of 72 really comes down to this, is if you earn 7.2% interest on your money, that in 10 years, your money will double. So in other words, $100,000 earning 7.2% interest each year, in 10 years later, will be worth $200,000. By the way, the true power of compound interest comes into play when you look at it the second decade. The $100,000 goes to $200,000, but the second decade, the $200,000 goes to $400,000. And by the way, the third decade goes from 4 to 8. So that is truly the power of compound interest. But the things that negatively impact that are losses, variations of results, variations of returns. Compound interest has to compound. It has to be a steady, consistent type thing. Each year you need to earn interest on interest, if you will, for compound interest to earn or to grow. And the key is you can't have that instability or that inconsistency, I should say, of returns, and losses are absolute killer. Again, if you want more information on that, go back to, moneyradio1510.com, go to the podcast, and listen to the previous show on compound interest. What we're going to talk about today, though, is really, I've gotten a lot of questions. So I've introduced the idea, the personal bank concept. Previously, last week, we had an awesome guest, John Burley, one of the top real estate educators in the country, best-selling author, all that kind of great stuff. Again, go back and listen to that interview if you want to learn more. The thing is, I get a lot of questions about your personal bank, intriguing a lot of people, introducing them to the idea of how this works. And so I'm going to cover some questions today in terms of how your personal bank can really, again, dramatically enhance your financial future for yourself, your business, your family. Now, again, before I teach you how a personal bank works, we've got to think in terms of thinking like a banker versus investor. And I've talked about this a lot. And again, one of my hats I wear, I'm chairman of the board of a community bank in formation right now, working on opening a bank here in Arizona, working with the FDIC and the bank regulators and everything else. I've been teaching these concepts for years, but now I'm on the board of a bank, so it kind of gives you a little credibility in that area. And again, if you want more information on these things, I always say you're listening to 1510 AM Money Radio. Go to moneyradio.com 1510 and get more information on this. Here's the thing. Thinking like a banker versus an investor. What is the difference? Well, I've shared this before, but I think it bears repeating. It's worth understanding because so few people teach this. It's just not taught in the general financial world. Here's what most investors do. Here's the difference. They trade hard-earned dollars for assets with the expectation the asset will increase in value. In general, that's what we do as investors, and that's what we're taught to do. And we primarily focus on potential gains only, which creates little or no cash flow in most cases, and we rarely ask, what's the recourse if things go wrong? Well, I always ask a simple question. If you purchase a stock, real estate, or business, can you tell me what it'll be worth in a year? You can look at charts, you can guesstimate. Here's the reality. You just don't know. Now, and I've done all of those things, okay, as many of us have. And we take what we call risk, measured risk, calculated risk, right? But we just don't really know what that asset's going to be worth a year from now, 5 years from now, etc. And by the way, this is not for me. This is in a number of different books. Investing for appreciation is just another form of gambling. If the investment, the only way you can make money is if it goes up in value and you don't have a plan for what happens if it goes down, really, what's the difference? And that's something that really needs to be considered. Of course, again, returns uncertain, little or no cash flow in most cases, and no downside protection. Okay, what's the difference? How does a banker think versus an investor? And by the way, and it really doesn't matter whether you like banks or hate them. I've had experiences with them, not necessarily all positive, obviously. I went through 08-09 as a real estate investor, had some ugly times. But here's the thing, learned a lot of lessons from it. Here's the thing. If you like banks or hate them, doesn't matter. Can we agree they're savvy about money? Can we learn from them? And there's no question that there is no industry more focused on being risk adverse than the banking industry. They look at money more different ways than I think anyone else does. It's amazing. But here's the thing. How do you think like a banker? Well, have you ever taken out a loan, like a mortgage or a car loan? At some point in our lives, most of us have. And when we signed the papers, we knew we would have a payment, right? Now, did we plan to make those payments? Of course we did. If you didn't plan to make the payments, you wouldn't be signing the papers. Plus, you went through a whole process of getting qualified for the loan, didn't you? And then, of course, if you didn't make those payments, what would have happened? Well, they would have taken the asset, right? They would have taken the house or the car, for example. Now, is a banker really risking their money? See, here's the thing to understand from the lending industry. Lenders very rarely lose money on collateralized loans. What do I mean by that? Well, a collateralized loan is, of course, a loan where if you borrow against it, the lender can take the asset from you if you don't make the payments. Cars and houses are a very common example. A non-collateralized loan is one where a lender lends you money, but there's no recourse for them in terms of taking assets. Credit cards, personal lines of credit are common examples of non-collateralized loans. Now, think about this a minute. today's interest rates, or at any point in time, really, you think about it, what's the typical interest rate on a car loan or a home loan for somebody with decent credit? Okay. Well, today's rates, are in the 4s, 5s, right, for those kinds of things. What's the interest rate on a typical credit card? Even with good credit, it's double digit. In other words, collateralized loans, loans where the lender has the ability to take asset from you if you don't pay them, the interest rates that they charge often are half or a third, even a quarter sometimes, of what a non-collateralized loan rate is. That's why credit card interest is so high. Because if you don't pay the credit card bill, it's not like they can come take your house or car. So the lending industry is showing you the risk that they are willing to take, the cost of the risk, collateralized versus non-collateralized loans. Now, why is this all important? Well, it's really quite simple. If I'm going to teach you how to think like a banker, you need to understand how bankers think. If you're going to operate like a bank in your personal life with your business, you got to understand how bankers think and why these things are important, like collateralized loans versus non-collateralized loans. So the criteria for a good business investment, for a banker is real simple: secure cash flow and collateral, downside protection. Doesn't matter what the rate of return is on the investment if you don't have those two criteria. If it doesn't create a cash flow and doesn't have collateral, from a banker's standpoint, that is a bad investment. So when people come to me, hey, I can get this investment, get this great rate of return, my question is typically, that's awesome, and I hope it works for you. But what is your plan B? What are you going to do if things don't work out? Because as we all know, in life, business, investing, whatever it is, money, things go wrong, don't they? Stuff happens. And losses are much more difficult to overcome than gains. After you've taken a loss, you're behind the 8 ball, if you know what I'm trying to say. You've got to make up that loss. So the bottom line is, you got to think like a banker versus an investor. And when we come back in the next segment, I'm going to teach you about how to operate your personal bank in the most maximum efficiency to maximize gains while minimizing taxes. Tune in Tuesdays at noon, Your Personal Bank show on 1510 Money Radio.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank show with President and founder of Secure Estate Management, Ference Toth.
Welcome back. Well, the first segment we were talking about access to your money. We were talking about the problems that interfere with that. We were talking about debt, consumer debt versus strategic debt. We're talking about taxes. We're talking about the power of compound interest, all those things. And if you want more information on those things, I highly recommend go back to our podcast, Money Radio, 1510am.com. Check it out. Go to Your Personal Bank show and check out those things. Wanted to really finish up on this thought of thinking like a banker versus an investor. And if you're going to operate like a banker versus an investor, what you're doing is you're minimizing risk, maximizing returns, and you're maximizing cash flow. You're maximizing income. And the reality is that's what we all need to live. That's what we need. Money, we need money, right, to live on, to do the things that we need and want to do. It's just that simple. So cash flow is key here. So how do you think like a banker versus an investor? If you're going to operate a personal bank, well, you got to understand how banks operate. And bottom line, here's how they do. When you get a check, what's the first thing we all do with it? We deposit in the bank. Most of us direct deposit, so we never even actually see the money, right? And what's the banks do with our deposits? Well, they loan it out, compound interest, cars, houses, credit cards, you name it. You know, what do banks really do? Well, let's say you walked in a bank and opened an account and you gave them some money. And then the next person walks in the door and they want a car loan. Does the banker take the cash you just gave them and turn around and give it to the car loan person? And I love asking this question when I'm in front of groups and speaking and stuff because most people think that's what happens. And I can tell you, as a banker, on the board of a bank, we're in formation, in the process of opening, I can tell you that is not what happens. What really happens is this. The bank takes the cash you just gave them and sticks it in their safe. Now, is cash an asset? Of course it is. Can you borrow against an asset? Of course you can. We do it all the time with cars, houses, 401ks, and all that good stuff, right? Well, here's the thing. You can check it up. Checking out. It's public record. Banks generally just don't invest in the stock market. They invest in a lot of other things that FDIC requires, Tier 1 capital requirements, all that type of stuff, because it's got to be safe, consistent cash reserves. What they do is they earn compound interest on our deposits. Most banks, over 80% of their income that's where it's coming from. And they borrow against the cash they hold to earn more interest. So you can too. It's a compounding effect, okay? And again, a personal bank, what is it? We create an asset that basically has guarantees, and it happens to be insured. Now, it has to be structured properly, and it's based on the claims-paying ability of the company and all that kind of good stuff. But the reality is it's a safe investment. And you want access to capital day one, okay? We want to earn interest on the asset and the borrowed funds. And we want tax-favored growth, okay? So this is a key thing to understand. Now, the financial tool that we use, I've shared this before, is an insurance contract. But it's a very specific type of insurance contract called high cash value with specific riders and structured specifically to maximize cash. See, there's reasons why we use this as a tool. We could use almost any financial tool for the personal bank, but we want something that we don't want to borrow against an asset that can lose value. We want to have access to 50 to 85% of our money day one, okay? We don't want penalties or other age restrictions involved, okay? So a lot of other investments are off the table. And we want to grow our money in a tax-favored manner. Again, takes off a lot of other options. And again, my biggest challenge, talking to people about, I say, hey, you need to look at this tool, and they'll think of insurance, and they'll think of it as a bill. They'll be, I got the home, the auto, last thing I need is another bill, tune out, stop listening, and then that's it. Well, here's the reality. They missed the whole point. The point is we're using this as an investment tool, as a cash growth tool, as a tool to maximize tax-favored cash over time to supplement retirement, college funding, all those kinds of things that exist out there. But the other thing is we can actually access the monies now, today, in the short term, for short-term cash flow needs. See, here's the thing I run into all the time. People run into problems. Life happens. Situations happen. And they invest their money like we're taught to do as an investor versus a banker. We're not taught to create cash flow. We're taught to invest our money to accumulate, right? Make our nest egg grow. Take on some risk and make it grow. And I'm not saying there's anything wrong with that, but here's the challenge I run into in everyday life with everyday situations. We grow this nest egg, and the problem we have many times is there are restrictions or limitations or tax consequences in accessing those funds when we need them. See, I'll give you a couple quick examples. Literally, I was doing a training last week, and I mentioned one of the keys to financial success is having access to capital. Now, that's whether you're an entrepreneur, a business owner, a real estate investor, a trader, or just an everyday individual person. Access to capital is key to financial success. Why? For two reasons. The first reason is simple. When you see an opportunity, you just know, hey, this opportunity is a great opportunity for me. I know this situation. I'm convinced I can make a good return on my money, all that good stuff. But if you don't have access to funds readily and available to take advantage of that opportunity without having high costs, penalties, or tax issues, that can prevent you from taking advantage of that opportunity, and you missed out. It's that simple. And that's really frustrating when you see an opportunity that you just know in your gut, as I put it, is a good one, and you can't take advantage of it because you've tied your money up, if you will, in a situation where you can't access it without tax situations or penalties or whatever. Or at the very least, if you take it out of whatever you're investing in, you put it into this opportunity, the money in the account you took out stopped growing, didn't it? So the risk, you got the risk-reward factor there. Should I take that money and put it into that other opportunity? if it doesn't pan out like I think, I've lost the forward growth or momentum of that money because I took it out of where it was. Why not have the ability to access money where you could take advantage of that opportunity? And whether that opportunity pans out or not, your money still has you still can grow your money compounding. I talked about in the previous segment the power of compound interest. Compound interest goes from 1 to 2, 2 to 4, 4 to 8, and so on. Over time, compound interest is powerful, and you want it to work for you. Okay? So having that access, that ready access to capital when you see the opportunity is massively important. And those are what I call active investors. Those are people, and what is an active investor? That's someone who takes their money and they use their money and their talents and their abilities, and they take that and turn it into an income-producing asset, or they grow a business. They're a real estate investor. They're some entrepreneur of some type. A lot of people, the day traders, the people that actively use their money to make money. That's an active investor, okay? Now, there are passive investors too. What's a passive investor? Well, it's basically somebody that takes money that they've earned, typically worked hard for, gives it to someone else to manage, and they passively let it grow, let that person manage it, let it grow. Am I negative to that? No. What I'm saying is access to capital, is that of benefit to the active investor? Of course. That's obvious. What about the passive investor? Absolutely. Why? Maybe that passive investor isn't out there looking for opportunities and other business opportunities to expand and grow their money. But here's the thing. Do they have expenses? Do they have bills? Do they have emergencies? Do things happen that they need to address and be able to access funds for those things? See, that's true for all of us, isn't it? Whether we're an active or a passive investor does not really matter. We need access to capital, okay? Now, you can have some cash reserves. These days, some people are still doing that. The rule of thumb, have 6 to 12 months in cash reserves to cover those emergencies. That's wise advice. But here's the problem. What kind of rate of return are you getting on money in the bank in a checking or savings account today? That emergency cash reserve fund. See, a lot of the advice, nothing, close to nothing, right? 0.0 something. There's a few of them out there that might pay you a point or so, but that's just your money's, if you will, dead dollars. I don't know what to tell you in terms of letting your money just sit and not do anything, where you could actually make it grow, have access to it, and let it grow, yet have access. That's one of the things I talk to people about all the time, is let it grow and have access to those funds while it's continue to grow long-term for retirement, college funding, or whatever that may be, okay? So here's the thing. Whether you're an active investor or a passive investor, it doesn't really matter. Having access to cash is important for opportunities to take advantage of those opportunities and expenses or emergencies when those things occur, while allowing your money to still grow. This has been awesome, and I'm going to share a little bit more in terms of some more questions I've gotten about your personal bank in the next segment. And I also want to mention next week we have a tremendous guest coming in, Ron Compton, estate planning attorney, one of the top ones in the state. We'll talk more about him next. Tune in, 1510 Money Radio.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to the second half of Your Personal Bank Show. We've been covering a lot of stuff in terms of the limitations of growing money. That would be taxes, debt, not tapping into the power of compound interest. And I've been talking about active investors versus passive investors and how Your Personal Bank can really come into play for both sets of folks. And some of the things I want to touch on really is some questions in terms I get a lot of the time is, and let me go back on that a sec. This is so important. An active investor needs access to funds. One of the keys to financial success, access to funds to maximize opportunities. And those funds have to be easily accessible. Can't have a lot of penalties or negative consequences, limitations, taxes, whatever, or loss of future growth. So you have to have ready access to those funds to take advantage of those opportunities. But then also, for all of us, whether we're active investor or passive investor, doesn't matter. We need monies for expenses. There's a cost to live, and we need monies to cover emergencies. And, these days, that's one thing I was touching on is, one of the financial concepts of the ages has been, have 6 to 12 months in cash reserves for emergencies. And that's good advice. But where do most people put that cash reserve? I find most people put it in the bank. And it's in savings and money market type of accounts and things like that. And unfortunately, for most of this past decade, the interest rates that people are earning on those types of accounts are well below 1%. In most cases, it's 0.0 something. So really, they've got some dead dollars, if you will. That's what I identify as dead dollars. Monies that are in an account that are just not growing, not doing much. I understand the purpose of those dollars. They're there to cover those emergencies if that ever occurs. But nobody ever said you had to stick it in the bank. And like I said, I'm a banker. I'm on the board of a bank. I can tell you, banks are happy to have those deposits. They'll loan it out and make plenty of return on your money if you won't let them. Do you want to make that interest or let someone else do it? Why not put that money in an account that has safety and guarantees built in, and why not earn some interest on that money better than the bank's interest rates, significantly more, and still have access to it if you need it? See, that's the key. You want to, I was with a group of real estate investors a couple of weeks ago up in Chicago, and I asked a simple question. I said, where can you go where you have access to funds, where you have no loan applications, no credit checks, you have guaranteed access to your funds, you gain control of your money. By the way, when you access the money, there's no monthly payments to pay it back, no repayment schedule set up. You pay back the loan on your schedule, which means you gain control of your money. Now, is there a cost to doing so? Yes, but you're talking about a very minimal cost, at a very low cost. The loan interest rate to do that, in many cases, can be as low as 0.5%. So you have access to the money without the applications, credit checks, like I said, without the payment schedule, and a very low cost to access the funds. Where can you get that money like that? And around the room, they all looked at me and said, nowhere. And I said, here you go. This is a resource that you can build cash into, and then have access for those opportunities or those expenses or emergencies when you need them, okay? Again, gaining control of your money. That is really key in terms of how you want to really consider setting this up, having access short-term, those short-term needs, while building long-term cash growth for your future, like retirement, college funding, and various things like that. Now, here's the other thing. Another question I get. Okay, I've looked at this, or I've had somebody talk to me about setting up a high cash value policy. And when I looked at it, it just didn't really have the cash that I thought it would. Well, let me tell you a little secret. Not all contracts are built the same way. Not all contracts are structured the same way. In other words, you could have the same product and have two different agents show you two different levels of cash funding. What do I mean by that? Well, it's really quite simple. If you think of a teeter-totter, the thing is how most insurance contracts are structured are little or no cash. They're maximized, so that'd be the low side of the teeter-totter. The high side, the other side, would be the death benefit. So they have a limited amount of cash, and they're maximizing death benefit protection. It's really, a lot of agents will talk to and sell it or tout it as a cash accumulation tool, but it's really structured much more heavily towards death benefit protection. Now, when people ask me, when I look at these, I look at these illustrations and I look at these numbers and I say, let me ask you a question. Are you trying to maximize cash or are you trying to maximize death benefit? And, are there death benefit protection needs that people have? Absolutely. Should you address those needs? Absolutely. I have those needs. I have a business. I have a family. I have to address those needs myself. Well, here's the thing. When I get the answer of, well, I want to maximize cash, or I thought that's what this was supposed to do, to maximize cash, then I look at them and say, well, this contract is not structured to maximize cash. It's more structured to maximize death benefit. How can you know? As a non-licensed agent advisor, how could you know whether what you're looking at is really structured in your favor to maximize cash or maximize death benefit? I'm going to tell you a little secret. I'm going to share with you how you can know quickly and simply, in the matter of seconds, know whether you have the right structured contract. And here it is. Here's the secret. If you look at an illustration and you look at the cash value line and you look at the first year line, if you don't have at least 50 to 85% cash first year, your contract is not structured to maximize cash. Excuse me. I'm going to say that again because this is so powerful. And by the way, I have people in our industry that get mad at me and say, why are you sharing that? You're giving away the secret sauce. I understand. And if you want to know more information about this, by all means, contact us at yourpersonalbank.com or toll free 866-515-6280. I'm going to say this again. What's the secret sauce? Here it is. If you are looking at an illustration on a high cash value contract, or any insurance contract for that matter, and it's supposedly designed to maximize cash, look at the first year cash value line. If there is not at least 50% to upwards of 85% cash available first year, your contract is not designed to maximize cash. Your contract, or the one you're looking at, is designed to maximize death benefit. Why would people do that? Why would they say they're going to maximize cash when in reality it's maximizing death benefit? Well, the next segment, I will share with you the reason why. Again, contact us. Toll free 866-515-6280 for more information, or yourpersonalbank.com. And tune in every Tuesday at noon, Money Radio 1510.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back, everybody. We're rounding third, coming in on our fourth segment. I just want to touch on real quick. We've covered a lot of great stuff today. We've talked about the three biggest reasons that impact negatively cash flow. Of course, that's debt, taxes, and not tapping into the power of compound interest. We've touched on how your personal bank can maximize cash flow. We've talked about how to think like a banker versus an investor. And again, I would recommend, if you want more information on any of those things previously on this show or any of our previous shows, go to moneyradio1510.com, go to the podcast and look up the Your Personal Bank Show and check it out. The last segment, I just finished off on something that a lot of people in my industry are, I'm talking about advisors, agents and such, that are frustrated that I share this information, because what I'm doing is I'm giving you the secret sauce. I'm actually pulling back the curtain, if you will, and showing you behind the scenes of how these things are structured and structured properly to maximize cash value versus maximizing death benefit. A lot of these cash value tools are sold or hyped as cash value accumulation tools. Great example. I shared, I was with an attorney a couple weeks ago in Chicago. She'd been introduced to this concept through her law firm, this is a tool that's used very commonly in law firms with partners and such like that as an executive compensation package. I see this often. She showed me an illustration of a contract that was designed, quote unquote, to maximize cash. I always ask the person the question, are you trying to maximize cash or are you trying to maximize death benefit? And again, think of a teeter-totter, how your dollars are allocated. Are they allocated towards the cash side or the death benefit side of this tool? And we looked at her illustration. She was contributing a fairly significant amount of funds annually, and her first year cash value was zero. And I just asked her a really simple question. I said, you're a smart person. She's an attorney. And I said to her, look, how does it make logical sense to you that you're setting up a cash accumulation tool and your first year cash available to you is zero? Does that make any logical sense to you at all? And she goes, well, no. When you think about it, no, not at all. I said, here, and then she asked me the question, why, which I get often. I said, it's really simple. Whoever structured this contract did not structure it adequately at all towards cash growth. They structured it heavily, much more heavily, towards death benefit protection. And I repeated my question, are you wanting to maximize death benefit or are you wanting to maximize cash? She goes, this is an executive compensation, tax-favored compensation plan. It's supposed to grow cash. I said, exactly. Again, I shared the secret sauce in the last segment. I'm going to do it again right now for those you didn't hear last few minutes ago. If you're looking at one of these, or if you have looked at one of these previously, or you have one currently even, look at the first year cash value availability. If you don't have at least 50% cash available, and by the way, you can have upwards of 85%, depending on how we structure these. There's variations, of course. Then you do not, and I repeat, you do not have a cash value. You are not maximizing cash accumulation and cash growth. It's that simple. You have what's called, quote unquote, a high cash value insurance contract that is not structured to maximize cash growth. That's the simplest and easiest way I can show you and share with you how you know immediately. And by the way, we do comparisons all the time. Recommend contacting us at yourpersonalbank.com or toll free 866-515-6280. Happy to run the numbers and compare and show you. But most cases, when we're doing the comparisons, we're showing, as I stated before, 50 to 85% cash available first year. And most of them we look at first year, little or nothing. Many of them we look at zero cash available in the first 2, 3, sometimes even 4 years. Now, why? Let me share with you one other secret. Why would someone, an advisor, an agent, whatever, why would they share a tool, again, quote unquote, to maximize cash value, yet not be doing that? Well, there's really two main reasons. The first, the agent, advisor, whoever it is you're talking to just doesn't know any better. They went to the company or the illustrator and they gave them an illustration, and this is what they gave them. They're not familiar they're not an expert in this area. By the way, not many advisors are. Most focus on managed funds, stock bonds, mutual funds. The vast majority, that's a fact that most of us know, the vast majority of financial advisors focus on that area of the financial world. Again, that's not a problem. That's not a negative. That's just the facts of what they do. There's very few specialists. I'm a specialist in the insurance arena. I'm a specialist in maximizing cash value tools in the insurance arena, and that's very, very much a specialty, not unlike a brain surgeon would be versus a general practitioner doctor. And if you're asking the general practitioner, brain surgeon type questions, are they going to know the answers? Again, it's not a negative. It's just a fact. That's not their specialty. So many of them take an illustration or get whatever's given to them. They don't know any better that it can be adjusted, tweaked, or adjusted, and then they go with what was given to them. Okay? That's probably the most common reason. The second reason is not so nice, but it is also a fact. And that is, and I ask this question to people all the time because they'll ask, why? It's really simple. Again, think of the teeter-totter. Your money's allocated either the cash side or the death benefit side, right? The majority of commissions that are paid to the advisor, agent, whoever is recommending this, do you think it's on cash or do you think it's on the death benefit protection tool, the insurance contract? Cash is cash. It's not a whole lot of commission involved in cash, okay? Or, compensation, if you will. Certainly, there's commissions and compensation involved with insurance contracts. So if someone's maximizing the death benefit side, the insurance contract side, they're maximizing their commissions. That's the facts, folks. I wish there was a nicer way to put it, but it's like a pie. You can cut the pie up into a certain amount of slices. There's only so much to go around, if you will. And so if you give money to an insurance company to maximize cash, get tax-favored growth, have access to the money, build a long-term tax-favored retirement program, have long-term care protection built in, have death benefit protection, all those benefits that these things provide. But it's structured, your goal was to maximize cash, and it's structured to maximize death benefit. It's going to be heavily weighted towards the death benefit side. The money's going to go on that side. Yes, your heirs will get more money, but so will your advisor or whoever recommended it to you. By maximizing the cash, as we do for our clients, we are therefore minimizing our commissions on these contracts. We're minimizing our compensation. We make much less per case than the typical average agent advisor does. Why? Well, we do a lot more volume as a result because we're doing what is the client wants to maximize their cash growth. It's that simple. So again, if you want to really understand how this works or you have any further questions or want to compare some numbers, contact us. Toll free, 866-515-6280 or yourpersonalbank.com. Again, yourpersonalbank.com. And don't forget to tune in on every Tuesday at noon for the Your Personal Bank Show on Money Radio 1510 AM or 105.3 FM or moneyradio.com. We'll see you next week.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.